Hey everyone, welcome to today's session on security market indices. I hope you're all feeling energized because we're about to learn a fundamental topic that's crucial for the CFA Level 1 exam, and honestly for your entire finance career. You might have heard terms like the S&P 500 is up 2% today, or the Dow Jones dropped 500 points. But what do these numbers really mean? What are these indices? And why should we care? Well, buckle up, because by the end of this lecture, you'll not only understand what these indices are, but also how they're constructed, calculated, and used in the real world. Let's keep it light, practical, and relatable. Ready? Let's jump in. What is a security index? Imagine trying to keep track of every single stock in the market individually. It would be like trying to count every grain of sand on a beach. Not exactly practical, right? That's where security indices come in. Think of a security market index as a cheat sheet for the market. Imagine trying to track every stock or bond. Overwhelming, right? Indices are like summarized reports, offering a snapshot of a specific market segment, or asset class. For example, the S&P 500 index tracks the performance of 500 large cap US companies. When people say the market is up, they're often referring to indices like the S&P 500. Think of security market indices as your go-to cheat sheet for understanding the stock market. Originally, they were created just to track US stocks, but now they do way more. They help simplify market analysis, give a single snapshot of market performance, and are key tools for investors. These days, they're used to monitor markets, assess investment risk, evaluate fund managers, and even serve as a blueprint for creating new investment products. Before we move on, let me point out something that's going to seriously up your revision game. Right here on the screen, you're seeing battle-ready summaries by FinQuiz that are absolutely perfect for your review sessions. These aren't just ordinary notes. They're expertly crafted, concise, and designed to help you ace those CFA Level 1 exams. And as you may know, from the 2025 CFA exam isn't just about simple pass-fail outcome. High scores matter now more than ever. That means you can't just aim to pass. You've got to own every concept. The best way to do that? Drill it in over and over. Use FinQuiz battle-ready summaries to lock in your understanding and make sure you're ready to crush it on exam day. Imagine having the ultimate cheat sheet at your fingertips, streamlined for fast recall. Trust me, once you download and print these, you'll wonder how you ever studied without them. So don't wait, click the link below to download and print your copy now, and let these summaries power your journey to success. Now, let's talk about security indices. In simple terms, a security index is like a report card for an entire market, a specific segment, or an asset class. It's built just like a portfolio of stocks or other securities, and its value is updated regularly based on actual or estimated market prices. The individual stocks or assets inside an index, those are called constituent securities, basically the building blocks that make up the index. In our S&P 500 example, the constituent securities are the 500 companies included in the index, like Apple, Microsoft, and Amazon. Speaking of those constituent securities, they're like the ingredients in a recipe. Each one plays a part in the overall flavor, or in this case, performance of the index. There are different types of indices, but two common forms you'll encounter are the price index and the total return index. All right, imagine you're only interested in the price movements of the securities, no dividends or interest payments, just the price tags. That's a price index for you. It's calculated using the unit prices of each security multiplied by the number of units in the index. The tricky part? There's a divisor that gets adjusted to ensure the index value reflects true market performance and not random changes like stock splits. So in simple terms, the divisor keeps everything in check. A price index reflects only the prices of its constituent securities. It doesn't account for dividends or interest. It's purely about price movements. So if you're tracking a price index, you're essentially seeing how the market's prices are changing over time without considering any income you'd earn from holding the securities. On the other hand, a total return index includes both price changes and income from dividends or interest. This gives you a fuller picture of what your returns would be if you actually held all the securities in the index. At the inception of an index, both the price index and the total return index have the same value. But as time goes on, the total return index usually ends up higher because it includes that extra income from dividends or interest. So how do we actually calculate the value of an index? Let's break it down in simple terms. Imagine an index as a portfolio that holds certain amounts of various securities. The value of a price return index is calculated by summing up the products of the number of units of each security and their respective prices, and then dividing by a figure called the divisor. The divisor, as I said earlier, is a number initially set when the index is created. It's adjusted over time to account for events like stock splits, dividends, or changes in the list of constituent securities. This ensures that these events don't artificially inflate or deflate the index value. Picture an index as a basket of securities. To calculate its value, multiply the number of units of each security by their prices. Add it all up. Divide by the divisor, which ensures stock splits and other events. Don't mess up the calculations, folks. Let's make this concrete. Suppose we have an index consisting of 3 stocks. Stock A, 100 shares priced at $50 each. Stock B, 200 shares priced at $30 each. Stock C, 150 shares priced at $20 each. First, we calculate the total value by multiplying the number of shares by their prices. Adding these up gives us a total value of $14,000. Now, suppose our divisor is set to 1,000. We divide the total value by the divisor to get the index value. So the index value is 14. The price return measures the percentage change in the index value due solely to price movements. Using our example, if the index value increases from 1,000 to 1,100 over a period, the price return is calculated as the difference between the ending value and the beginning value, divided by the beginning value. So folks, the price return is 10%. The total return includes both the price appreciation and any income from dividends or interest. So if the index constituents paid out $20 in dividends per unit of the index, the total return would be 12%. So while the price return is 10%, the total return is 12% when we include dividends. Now, let's say you're looking to capture the full experience, not just price movements, but also any income, like dividends. That's where the total return index comes in. Over time, the total return index will outpace the price index because of the income reinvestments, and that gap grows the longer the index exists. So how do you measure returns? 2 ways. You can look at the percentage change in the value of the index or take a weighted average of individual security returns. It's kind of like comparing your overall portfolio's performance to the performance of each individual asset in it. A multiple time periods index value represents the cumulative performance of an index starting from its initial level and updating as each period's return is applied. In this method, you take the original index value and for every time period, adjust it by the period's gain or loss. Each period's result builds on the previous one, so the effects compound over time. This approach captures the true growth or decline of the index, showing how successive returns accumulate to reflect overall performance. Imagine you start with an index at some initial baseline value. Think of it as the day one figure. Each subsequent time period, the index either rises or falls by a certain percentage, which we call the return. For example, if the index gains 5% in the first period, you multiply the starting value by 1 plus that 5%, in other words, 1.05, to get the new index value. In the next period, if it goes up another 2%, you again multiply by 1 plus that 2%, 1.02, and so on. By chaining together these 1 plus return factors across all time periods, you track the growth or decline of the index from its inception through each stage, ultimately revealing how much the price component of the index has changed over the entire journey. Let's make this real. Imagine an index starts at 1,000 points. If it increases by 4.5% in the first period, it goes up to 1,045. Add another 3% increase in the next period, and you're sitting at 1,076.35 points. See how this adds up? And if you include dividends in the calculation, the total return index will give you an even higher figure. Imagine you're standing in a financial district, surrounded by soaring skyscrapers, each housing countless firms with their own unique business models. Now, picture you've been asked to capture the essence of that entire financial scene in a single measure, a yardstick that tells people whether the market is going up, down, or sideways. That's essentially what an index does. It's a distilled representation of a larger market or segment created by selecting and weighting a set of securities. So next up, we're going to explore how these indices are constructed, and by the end, you'll see just how critical these decisions are for investors, analysts, and even the broader financial system. Target market and security selection. The first step in building an index is identifying its target market. You might decide to focus on all publicly traded stocks in a specific country, or you might zero in on a narrower segment like high-yield corporate bonds in the US, or even large-cap tech firms across the globe. Think of it like creating a menu for a restaurant. You need to decide whether you're serving Italian, Japanese, or fusion cuisine before you even start picking out ingredients. Once you've pinned down the target market, let's say US large cap equities, you then select which specific companies fit the bill. Some indices, like the S&P 500, aim to capture a broad chunk of the largest and most established companies, while others, such as certain sector-focused indices, might only include companies from, say, the renewable energy space. In some cases, the number of constituents is fixed, like 500 for the S&P 500, whereas other indices vary their count to maintain a certain percentage of the overall market capitalization. The process of deciding which securities make the cut can be purely mechanical, such as include any stock with a market cap above $5 billion, or it can be more subjective, involving a committee that checks additional criteria like liquidity, profitability, or growth potential. This ensures the index stays relevant and truly reflects its intended market slice. After you've chosen the securities, the next big question is, how much of each security should the index hold? It's a bit like baking a cake. Do you use a cup of sugar for every cup of flour, or do you add ingredients in different proportions? Each weighting method has its own flavor and can significantly influence the index's performance and characteristics. So our next part is index weighting. Ever wondered why some stocks in an index seem to matter more than others? It's all about the weighting method. There's price weighting, where more expensive stocks carry more weight. Hello, Dow Jones. And then there's equal weighting, where every stock gets the same importance regardless of its size. For example, in the Dow Jones, a stock price at $300 has more impact on the index than a $30 stock, even if the $30 stock represents a much larger company. It's like a pizza where the slices are cut unevenly. Some slices have way more toppings than others. So let's get into the details. A price-weighted index is the simplest to grasp on paper. Imagine you're constructing a mini portfolio where you buy exactly one share of each stock on your list. If stock A trades at $100 and stock B at $20, stock A will have 5 times the weight of stock B in your index. The Dow Jones Industrial Average is a famous real-world example of this approach. While this seems straightforward, it can lead to some odd distortions. Let's say a high-flying tech company with a share price of $300 undergoes a 3-for-1 stock split, dropping its share price to $100. Even if the company's overall market value hasn't changed one bit, its weight in a price-weighted index plunges. In real business terms, you can picture a successful retail chain that splits its stock regularly to keep its share price accessible to smaller investors. Suddenly, in a price-weighted index, that retailer's impact on the index might be significantly reduced, just because of the split, not because its business fundamentals have changed. With equal weighting, every security gets the same slice of the pie. Suppose you're tracking 5 stocks. You put 20% of your money in each. If one stock's price soars, it soon represents more than 20% of the portfolio. So at rebalancing time, you'll sell some shares of the high flyer and redistribute the proceeds to the others. This ensures that each stock's influence remains identical over time. This method sounds perfectly fair. Everyone gets an equal seat at the table, but here's the catch. You often end up leaning heavily into smaller, potentially riskier companies. If you have Apple and a tiny startup both weighted equally, the small firm's wild price swings might create more volatility than you'd expect in a more traditional market cap weighted index. Plus, you'll need to rebalance regularly to maintain those equal weights, which can lead to higher transaction costs. Still, for some investors who believe in a democratic approach or who want to systematically trim winners and boost laggards, equal weighting can be attractive. Next up, the classic market cap weighting. Market cap weighting is the big dog in the index world. Picture the S&P 500. Each stock is weighted according to its total market value, which is simply share price times the number of shares outstanding. If a tech giant is worth $2 trillion and a small airline is worth $2 billion, that tech giant gets 1,000 times the weight of the airline in the index. The appeal is that this approach automatically adjusts for company size and market fluctuations. When a stock's price rises, its weight in the index goes up. If its price falls, its weight drops. In real-life terms, if Tesla's market cap skyrockets after an earnings report, it becomes a bigger part of a market cap-weighted index, reflecting how actual investors in the aggregate market now value Tesla more highly. However, this also means that the index can become heavily dominated by a handful of mega-cap companies. If those companies are overvalued, think back to the dot-com bubble, the index might overweight them right before they crash. Critics say market cap weighting can turn into a momentum play, where winners keep winning simply because they get more weight, regardless of whether they're truly good value. Float-adjusted market capitalization weighting. Float-adjusted weighting is a twist on the market cap approach. Instead of using all outstanding shares, it only counts the shares actually available for trading. Shares locked up by founders, governments, or other long-term holders who rarely sell aren't included. The idea here is that an index should reflect the supply of shares that regular investors can realistically buy and sell. If you consider a state-owned telecom giant where the government holds 60% of the shares, only 40% might be floating on the open market. The float-adjusted index weighting will then calculate market cap based on just that 40%. This method is used by many major indices, including the modern S&P 500, to better represent the tradable market. Fundamental weighting. Finally, we have fundamental weighting, which ignores share price altogether. Instead, it looks at metrics like revenues, earnings, book value, or even number of employees. The logic is that a company's real economic footprint should determine its weight, not how the market happens to be pricing its shares at the moment. Imagine a large, steady grocery chain with modest stock performance but huge annual revenues. Under a fundamental weighting approach, say weighting by total sales, that grocery chain might get a hefty portion of the index. A tiny biotech firm with a sky-high share price, but minimal revenues on the other hand, would get a relatively small weight. This approach can act like a built-in contrarian strategy. If a stock's price shoots up, but its fundamentals don't follow suit, its weight won't balloon nearly as much as it would in a market cap index. Of course, fundamental can mean different things to different people. Some might focus on cash flow, others on dividends or earnings. There's no universal agreement on which measure is best. But for value-oriented investors, this method can help avoid putting too many eggs in the basket of overhyped growth stocks. Oh, and one last thing, when it comes to investment strategies, there are two major schools of thought, momentum and contrarian. Momentum strategies are like riding a wave. Investors focus on stocks that are already climbing, hoping they'll keep going up. Indexes that use value weighting and float adjustments naturally give more weight to these rising stocks, meaning they get a bigger piece of the action as the market moves. On the flip side, contrarian strategies are all about going against the crowd. Instead of chasing trends, these investors look at the fundamentals, things like earnings, assets, and valuations, to spot stocks that are undervalued. It's a classic value investing approach, where the goal is to buy low and wait for the market to catch up. Imagine you're managing a portfolio that's weighted by fundamentals, perhaps based on each company's earnings or book value. Now, fast forward to your regular rebalancing date. You notice one stock has skyrocketed in price since the last rebalance, but its earnings haven't grown nearly as fast. Under a fundamental weighting scheme, that stock's weight won't expand to match its ballooning share price, at least not by as much as it would in a market cap weighted portfolio. Instead, you might trim your position in that high flyer back to align with its fundamental metrics. Conversely, if another stock has fallen in price even though its earnings remain strong, you'll end up increasing its weight to match its still solid fundamentals. This process of cutting back on recent winners and boosting losers echoes the contrarian mindset, where you sell high and buy low. In a contrarian strategy, any security that's become relatively expensive is pared down, while the laggards, provided their core business metrics are intact, get a bigger slice of the pie. Over time, this approach can help you avoid overpaying for hype-driven stocks and capitalize on undervalued names that might be poised for a rebound. To illustrate how all these pieces come together, let's imagine you're tasked with creating the Global Tech 30 Index. First, you define your target market, the 30 most prominent tech companies worldwide. You might decide that's strictly about software and hardware, excluding telecoms or media. Next, you pick the securities, the actual companies that best fit your definition of tech. Maybe that includes some familiar names like Apple, Microsoft, Alphabet, plus a few Asian giants and European chip makers. Now you choose a weighting scheme. Let's say you go with float-adjusted market cap weighting to ensure that only the shares available to everyday investors count. As the market evolves, maybe a new AI-focused startup rockets into the top 30, you'd reconstitute the index to bring it on board. And every so often, you'd check whether your current constituents still meet the criteria, rebalancing as needed to reflect changes in float and share prices. So, folks, index construction might sound like a straightforward task. Choose some stocks, do some math, and voila, you've got an index. But in reality, every choice you make can alter the index's behavior, risk profile, and how well it represents the target market. From the big question of which securities should I include, to the nitty-gritty of how do I weight them, and when do I rebalance, the decisions involved in index construction have far-reaching implications. So next time you hear a financial pundit say the market's up 2% today, remember that it all depends on which index they're referring to and how that index was built. Understanding these concepts will not only prepare you for the CFA exam, but will also give you a sharper lens through which to view the global investment landscape. And who knows, maybe you'll be the one designing the next big index that everyone else uses to gauge market performance. Now, let's talk about index management, where we will discuss rebalancing and reconstitution. Now, I know what you're thinking. Index management? Really? But trust me, it's more exciting and important than it sounds. Plus, it's something you'll need to know inside and out for the CFA Level 1 exam. Indices don't stay static. They need regular rebalancing to ensure weights remain aligned with the chosen method. Imagine you're cooking up a big pot of investment stew. You've got a recipe that calls for precise amounts of stocks, bonds, and other securities to get that perfect flavor. But over time, the ingredients start shifting. Maybe the stocks swell up while the bonds shrink. Before you know it, your stew's proportions are all out of whack. That's where rebalancing comes in. Rebalancing is like adjusting your recipe back to its original proportions. In the world of indices, it means tweaking the weights of the securities in the index to match the intended weighting method. This usually happens on a regular schedule, quarterly, for example. Why bother? Well, as market prices change, so do the weights of the securities in the index. If left unchecked, this can distort the index's representation of the market segment it's supposed to track. For instance, if a tech giant's stock price doubles, its weight in the index might become disproportionately large, overshadowing other companies. But here's the kicker. Rebalancing isn't free. It generates transaction costs because you're buying and selling securities to adjust those weights. So index managers have to find a balance, pun intended, between maintaining accurate weights and keeping costs low. Now here's a quick note on different weighting methods. Price-weighted indices, like the Dow Jones Industrial Average, don't need rebalancing. The weights adjust naturally as stock prices change. Now, market capitalization weighted indices like the S&P 500 mostly rebalance automatically, but they still need adjustments for events like mergers or acquisitions between scheduled rebalancing dates. Now, let's say one of the companies in your index goes bankrupt or gets acquired. Keeping it in the index wouldn't make much sense. right? That's where reconstitution comes into play. Reconstitution is like overhauling your investment stew's ingredient list. It involves adding, removing, or replacing securities to ensure the index accurately reflects the target market. This isn't just tweaking quantities, it's changing the components themselves. Here's how it works. The index provider revisits the original criteria used to select securities. This might include market capitalization thresholds, liquidity requirements, or sector classifications. Based on these criteria, they decide which securities to keep, remove, or add. For example, if a small cap index finds that a company's market cap has grown too large, it might replace it with a smaller company. After the new list is set, the index reapplies its weighting method to assign weights to each security. An interesting phenomenon occurs around reconstitution dates. The prices of securities being added to the index tend to increase because fund managers who track the index start buying them. Conversely, prices of securities being removed often decrease due to selling pressure. Just like rebalancing, reconstitution generates transaction costs and causes turnover within the index. And it typically happens less frequently, maybe annually, like with the Russell 2000 index. On the official reconstitution date, all these changes become official. Here's the juicy part. Stocks newly added to an index typically enjoy a bit of a price boost, while stocks getting dropped might see their prices fall, so there's always some drama around reconstitution time. All right, now, let's explore some of the practical ways equity indices used in finance. Like, what exactly investors use them for? So guys, indices are more than just numbers scrolling across a news ticker like on CNBC or Bloomberg. They serve several functions in the investment world. They guide investment strategies, help assess market sentiment, and even shape your portfolio decisions. Let's walk through their most common uses and understand why they matter. First up, indices are often seen as gauges of market sentiment. What does that mean? Well, they're used to get a sense of how the market as a whole is feeling, whether there's a bullish, optimistic vibe or a bearish, cautious mood. It's like checking the market's temperature. But here's the catch. Indices are made up of a representative sample of securities, not every single stock out there. So while they give us a pretty good idea, they're not a perfect reflection of overall market sentiment. Next, indices are super handy as proxies for various financial metrics, like measuring returns, assessing systematic risk, that's beta for all you finance folks, and evaluating performance. In the US, the S&P 500 is often used as a stand-in for the market portfolio of risky assets. If you hear someone say they're comparing their fund's performance to the market, they're likely talking about the S&P 500. Here's a cool example. If you have an actively managed global stock portfolio with a beta of 0.98 compared to the MSCI World Index, you could construct a passive portfolio with the same risk level. You just invest 98% in an MSCI World Index fund and hold 2% in cash. Boom. You've got a passive portfolio that mirrors the systematic risk of your active one. So what does this mean? This means your portfolio is almost as risky as the global stock market, just slightly less volatile. If you wanted to mimic that same risk level passively, without all the stock picking and active management, you'd create a passive investment mirroring the MSCI World Index itself. This allows investors to fine-tune their exposure to market risk without paying high fees for active management. And then there's alpha, the holy grail of active management. It measures how much an actively managed portfolio outperforms or underperforms a passive one with the same level of risk. If your portfolio has a positive alpha, congrats, you're beating the market, risk adjusted. If not, well, maybe it's time to rethink your strategy. Another popular use of equity indices is as a proxy for asset classes in asset allocation models. Think of them as blueprints for understanding the risk and return profiles of different groups of securities. Imagine you're a financial advisor helping clients create a balanced investment portfolio. Rather than choosing individual securities, you might allocate their assets using indices because these indices provide you with historical data on risk and return patterns. Think of it like building a meal at Chipotle. Instead of picking each ingredient individually, you might choose pre-built combinations, burrito bowls, that already have exactly the flavors and nutrition risk-return profiles you're looking for. Indices serve this exact role. They simplify the complicated task of deciding how much to allocate to different asset classes. They provide historical data that help us model risks and returns. For instance, if you're constructing a diversified portfolio, you'll want to look at how different asset classes like equities, bonds, or real estate have behaved over time. Indices give you that data. Another big use of indices is as benchmarks for evaluating actively managed portfolios. Now, this part is key. You can't just pick any index as your benchmark. It has to align with the investment strategy of the portfolio manager. If you're managing a small cap fund, comparing it to the S&P 500 doesn't make much sense, right? Using the wrong benchmark could lead to misleading conclusions about how well or poorly a manager is performing. So choosing the right benchmark is like choosing the right opponent in a tennis match. It needs to be a fair comparison, or the results don't mean much. Last but not least, indices can serve as model portfolios for new investment products. Think about broad market index funds or exchange-traded funds, ETFs. These products are often built to track specific indices, making them easy for investors to understand and invest in. For example, if you want to invest in the entire US stock market without picking individual stocks, you can buy an ETF that tracks the S&P 500 or the Russell 3000. Indices provide a clear, rule-based way to develop and monitor these investment products. So before we move forward, I want to remind you that the FinQuiz battle-ready summaries you see on screen break down these complex concepts into clear, easy, actionable insights that have helped countless candidates succeed. If you'd like to take your study further, check out the link in the description below to purchase these summaries. And don't forget, guys, FinQuiz has more targeted materials you can check out. They'll make your revision process smoother and have been a staple for successful candidates for years. All right, folks, now we're jumping right into equity indices. And trust me, this stuff isn't just numbers on a screen. Equity indices are like the heartbeat of the stock market, telling investors at a glance what's moving, what's shaking, and where opportunities might be hiding. Let's break it down into easy to understand categories that you as CFA Level 1 candidates need to master for exam day and beyond. First up, broad market indices. Think of broad market indices as the big picture indices. They represent the vast majority of an entire equity market. For instance, take the Wilshire 5000 Total Market Index in the US. It's like taking a snapshot of practically every publicly traded company in America, over 6,000 stocks, covering about 90% or more of the market. This means if you're curious about how the entire US equity market is doing at any given moment, this index has you covered. Investors use these indices as benchmarks to gauge overall market performance and to measure their portfolios against the market. Next, let's talk multi-market indices. Multi-market indices aren't limited to just one country. They combine markets from different countries into one comprehensive index. It's a bit like assembling an international sports team with star players from all around the globe. A classic example here is the MSCI Barra Index, which tracks developed and emerging markets across many countries. They reconstitute, that's a fancy way of saying update, their indices regularly to reflect changes in how countries are classified, say if a country's economy moves from emerging to developed status. Some multi-market indices go even further. Securities within each country are weighted by market capitalization, but then each country's representation in the index gets weighted based on its GDP. It's a clever way to keep the index reflective of global economic realities. Third, we've got sector indices. Now, sector indices zoom in a bit. They focus on specific segments of the economy, like healthcare, finance, energy, consumer goods, or tech. Picture these as specialty stores in a big shopping mall. If you want shoes, you go straight to the shoe store, right? Similarly, if you're specifically interested in tech stocks, you'd head straight to a technology sector index. These indices are often grouped together in families, meaning if you combine all these different sectors, you'll end up with something that resembles the broad market. Investors and portfolio managers love sector indices because they let them showcase their stock picking or sector allocation skills. These indices also underpin sector-specific ETFs and other investment products. Finally, style indices, where things get interesting. Style indices categorize stocks based on specific investment characteristics or styles. Think of it like fashion trends. Are you a casual, sporty investor who prefers steady, reliable value stocks, or maybe an edgy trendsetter who loves growth stocks with huge potential upside? Style indices cover these investor preferences clearly. Style indices typically use 3 different classifications. Market capitalization. Stocks are divided into large cap, mid cap, and small cap groups. A large cap stock might be something big and steady like Coca-Cola, while small cap stocks could be those tiny startups aiming for explosive growth. Value versus growth. Value stocks generally trade at low valuation ratios, like low price to book or price to earnings ratios, and might pay higher dividends. Think stable companies like Coca-Cola or IBM. Growth stocks, meanwhile, often have high valuations but tons of future potential. Think Tesla or Netflix. Hybrid classifications. Sometimes indices mix these 2 dimensions, giving you categories like large cap growth, mid-cap value, small cap growth, and so on. This gives investors finer control over what they're tracking, but it also means that stocks can move between categories whenever their valuations or size change, leading to higher turnover during index rebalancing. Here's an important real-world detail for CFA candidates. When style indices are rebalanced, called reconstitution, stocks frequently shift from one style category to another. For example, a successful small cap growth company might graduate into the mid cap growth category after its stock price rises significantly. That's good news, of course, but it also creates higher turnover in style indices, impacting how portfolio managers track these indices. So, folks, equity indices are your roadmap through the stock market, whether you want the big picture view, prefer to look across multiple markets, or want precise sector-specific insights. Stick around, keep these categories clear in your mind, and you'll be navigating the equity market landscape like a seasoned pro in no time. All right, folks, now let's roll up our sleeves and explore the fascinating and admittedly tricky world of fixed income indices. If you thought equity indices were a handful, just wait until you get a load of this. Bonds, after all, aren't your straightforward plain vanilla shares. They're more like a dynamic puzzle, always changing and packed with quirks that make indexing them a real adventure. First off, why exactly is constructing a fixed income index such a tough gig compared to an equity index? Well, let's think about the bond market as this massive, always moving machine. It includes securities from governments, government agencies, corporations, you name it. These bonds come in all sorts of flavors too. You've got your zero coupon bonds that pay nothing until maturity, callable bonds that the issuer can snatch back if rates fall, putable bonds investors can send back to issuers if rates rise. There's a bond type for almost every scenario imaginable. It's like going to an ice cream parlor with hundreds of flavors and toppings. Sounds exciting, but good luck making sense of it all. Now here's the kicker. This bond market never stays still. Imagine you're watching Netflix, and every few minutes, your favorite show changes to something completely different. New bond issues pop up constantly, older bonds mature, some bonds get called back by their issuers, and others are pulled into sinking funds. The universe of fixed income securities just won't hold still, making it tricky for index providers to keep their indices accurate and relevant. And guess what makes it even messier? The bond market is primarily a dealer-based market, meaning bonds aren't traded on nice, clean exchanges with transparent prices like stocks. Instead, bonds often trade infrequently or even rarely, so index providers can't just grab market prices from a live ticker. They have to rely on dealers, those financial middlemen, to give them quotes, or sometimes use educated estimates based on similar bonds. It's a bit like asking around for the value of a rare vintage car that rarely hits the auction block. There's no clear market price, only expert guesses. On top of this, bond pricing has another layer of complexity, the concept of duration. Duration measures a bond's sensitivity to changes in interest rates and depends on the bond's maturity, coupon payments, and current market yields. Even small shifts in interest rates can cause bond prices to swing significantly, making accurate and timely indexing even tougher. All right, let's move to how we actually sort these bonds into categories, because trust me, there's method to the madness. Fixed income securities can be classified in many ways, just like equities. They might be grouped by economic sector, for example, government bonds versus corporate bonds, or by geographic region, like US Treasuries versus emerging market debt. They can also be sorted by issuer type, think general obligation municipal bonds or asset-backed collateralized bonds, by currency, or even based on whether they include inflation protection or not. Now, when it comes to the actual indices themselves, there are several key categories you should know about. Aggregate, or broad market indices, are like the big picture view designed to represent an entire bond market. A great real-world example is the Barclays U.S. Aggregate Bond Index, which captures a vast array of U.S. bonds, from government-issued to corporate bonds and mortgage-backed securities. If you want a quick snapshot of how the overall bond market is doing, this is your go-to reference. Market sector indices narrow things down by focusing exclusively on specific sectors like government debt, corporate bonds, or collateralized securities. Say you're managing a fund specializing in corporate bonds, you'd track a corporate bond market sector index to benchmark performance accurately. Style indices sort bonds based on characteristics such as maturity or credit quality. For example, maturity indices might categorize bonds as short-term, 1 to 3 years, intermediate, 3 to 7 years, or long-term, over 10 years. Credit quality indices might distinguish between safer investment-grade bonds and riskier high-yield or junk bonds. So if you're an investor who likes stability, you'd probably track a high-quality short-term index, But if you're feeling adventurous and chasing higher returns, a high yield index would be your thing. Economic sector indices drill down into bonds issued within specific industries: energy, healthcare, financials, useful if you have strong views about certain sectors. Specialized indices zero in on unique market niches like emerging market bonds, inflation-linked bonds, or exclusively high-yield bonds. For instance, if you want exposure specifically to inflation-protected securities, think TIPS in the US, there's a specialized index just for that. All right, now that we've covered the basics, let's zoom in on how fixed income markets are segmented for index construction. This isn't just an academic exercise, it's essential for investors who want to track, compare, and invest in bonds with specific characteristics. So, what are the key dimensions that shape these fixed income indexes? Let's take a closer look. First up, market scope. Where in the world are you looking? Do you want global exposure, or do you prefer to stay closer to home? Some investors focus on a single country or currency zone, like US Treasuries or euro-denominated bonds, while others prefer a broader mix spanning multiple regions. A global index gives you diversification, but also exposes you to currency and geopolitical risks. Then we have security type. What kind of bonds are in the mix? Are you looking at rock-solid government bonds, corporate debt from blue-chip companies, or something a little more exotic like mortgage-backed securities? Different bond types behave differently. Corporate bonds, for example, often have higher yields than government bonds, but come with credit risk. Next, there's maturity, short and sweet, or in it for the long haul. Some investors prefer short-term bonds for flexibility, while others opt for long-term bonds to lock in yields. A short-term bond index might track securities maturing in 1 to 3 years, while a long-term index could focus on 10-year or even 30-year bonds. Longer maturities generally mean higher yields, but also higher sensitivity to interest rate changes. And finally, credit quality, safety first, or are you willing to take a little risk? Are you sticking with AAA rated bonds where default risk is minimal, or are you venturing into high yield junk bonds where the returns can be juicy but come with added risk? Fixed income indexes often segment bonds by credit rating to help investors choose their comfort level with credit risk. Each of these dimensions plays a role in how bond indexes are structured and used by investors. And of course, they're not independent of each other. Many indexes slice and dice bonds across multiple dimensions. For instance, you might find an index that tracks U.S. investment-grade corporate bonds with a maturity of 5 to 10 years, combining security type, credit quality, and maturity into one focused benchmark. For CFA Level 1 candidates, understanding fixed income indices isn't just theoretical. It's important for your ability to interpret markets. Remember, bond markets are incredibly dynamic, with a huge variety of securities, constant changes, tricky liquidity, and subtle pricing complexities. If you grasp why each of these challenges exists and how indices overcome them, you'll gain real-world investment insights that go way beyond just acing your exam. All right. Now, folks, we're wrapping up our discussion on security market indices by exploring indices for alternative investments. This is the last piece of the puzzle, and it's an essential one to understand, especially if you're looking to diversify your knowledge and eventually your portfolios. So let's get right into it. When we talk about alternative investments, we're stepping beyond the traditional stocks and bonds. These include commodities, real estate, and hedge funds. Each comes with its own set of risks and returns. And to understand how they perform, we rely on specialized indices. Starting with commodities, think about the everyday essentials like the rice in your lunch, the crude oil fueling your car, or even the gold in your jewelry. Commodity indices track the performance of these goods, but instead of dealing with the actual physical commodities, they track futures contracts. These contracts represent agreements to buy or sell commodities at a predetermined price in the future. Commodity indices cover agricultural products like rice and wheat, livestock such as cattle and hogs, precious and common metals like gold and copper, and energy commodities such as crude oil and natural gas. Now, how are these indices weighted? Unlike equity indices, where the rules might be clearer, commodity indices use a variety of methods. Some indices, like the CRB index, use equal weighting, assigning equal importance to each commodity. Others, like the S&P GSCI index, assign weights based on liquidity and global production values, meaning commodities that are produced in larger quantities or have more active markets get a higher weight. There are also indices where a committee determines fixed weights. Why does weighting matter? Because it has a big impact on the returns and risk exposure of an index. For instance, the S&P GSCI gives about double the weight to energy commodities compared to the CRB index, while the agriculture sector holds only about 1/3 of the weight in comparison. This means that depending on which index you follow, your exposure to sectors like oil or wheat could look very different. So understanding how an index is weighted is key to making sense of its performance. When it comes to returns, commodity indices don't always align with the spot prices of commodities. That's because these indices are based on futures, which can behave differently from the actual commodities. The returns from a commodity index come from 3 sources. First, there's the return from changes in futures prices. Second, there's the collateral return, which is the interest earned on the collateral posted for the futures contracts. Lastly, there's the roll yield, which is the return gained or lost when rolling over expiring contracts into new ones. For example, consider an airline company hedging its fuel costs. It might enter into futures contracts to lock in prices, but if the roll yield is negative, it could end up paying more when the contracts are renewed. Now, let's move to real estate. Investing in real estate is often seen as traditional but solid. However, it's important to note that real estate is highly illiquid. Unlike stocks, you can't just sell a property whenever you want. Real estate transactions also happen less frequently, and there's often less transparency in information. Sellers might have more information than buyers. So how do we track the real estate market? Now, through indices, which can be categorized in a few ways, there are appraisal indices, which rely on periodic property valuations, and repeat sales indices that track price changes of properties sold multiple times. Then there are REIT indices, which are based on publicly traded real estate investment trusts. Think of REITs like mutual funds that invest in properties. They pool money to buy real estate assets, and their shares are traded on major exchanges. This makes them highly liquid compared to direct real estate investments. Plus, they provide an accessible way for smaller investors to gain exposure to the real estate market. The value of REIT indices is continuously updated thanks to constant market pricing. Imagine you're an investor who wants to invest in real estate but doesn't have the capital to buy properties outright. Buying shares of a REIT allows you to invest in real estate with less money while keeping your portfolio liquid. So folks, REIT indices are a fascinating slice of the market because they let everyday investors get in on real estate without needing a massive cash outlay or the hassles of property ownership. Essentially, REITs are pools of capital that invest in real estate or related debt. And since they're traded on major stock exchanges, they're as easy to buy or sell as any public equity. This high level of liquidity and continuous market pricing means you can tap into diversified real estate exposure, like commercial buildings or mortgage-backed assets, without tying up huge sums in a single property. Ultimately, REIT indices capture the performance of these funds, giving you a streamlined way to track the heartbeat of the real estate sector and opening doors for smaller investors to own a piece of that lucrative pie. Finally, let's talk about hedge funds. These are private investment vehicles that have more flexibility than traditional mutual funds. Hedge funds can take long or short positions and use high leverage. However, they also come with less regulation, which means less transparency. Hedge fund indices help track the performance of these funds, though creating these indices isn't straightforward. Most hedge fund indices use equal weighting, meaning each fund contributes equally to the index's performance. But here's the tricky part. Hedge funds can choose whether or not to report their performance and select which database they report to. This voluntary reporting can lead to biases. One major bias is survivorship bias. Poor performing funds might stop reporting or choose not to report at all, making the index appear stronger than it is. Another issue is database selection. Since funds decide where to report, different indices can give very different impressions of the hedge fund market. It's like reading restaurant reviews only from places with 5-star ratings. You'd think every restaurant is perfect, but that wouldn't reflect reality. Hedge fund indices can be skewed in the same way if they only include successful funds. Imagine a hedge fund focusing on distressed debt. The manager might snap up discounted bonds from troubled companies on the brink of bankruptcy, hoping for a turnaround. If that bet pays off, the rewards are huge. If it doesn't, losses can be spectacular too. These high-octane strategies are why they're called hedge funds, although sometimes it feels more like high-risk funds. Because hedge funds can invest in so many different ways, hedge fund indices exist to give us some sense of how these funds are performing on a broader scale, both globally and within specific strategies, like long-short equity, global macro, event-driven, etc. But it's important to note how these indices come together. Databases of hedge fund returns are maintained by various research organizations. Hedge funds typically choose whether or not to report their performance to these databases. As a result, there's less regulatory oversight compared to mutual funds. And another thing is hedge funds only have to share their numbers with their own investors. And then there is an issue that they can selectively choose which databases they report to. Because of this self-selection, the constituents of any given hedge fund index are determined by the funds themselves. That's why you might see the Global Hedge Fund Index A telling a very different story from Global Hedge Fund Index B. They could be tracking entirely different sets of funds. Most hedge fund indices are equal weighted. Each hedge fund that reports to the database gets the same level of representation. This can skew the index if there's a large cluster of smaller niche funds all pulling in one direction. So, folks, as I said earlier, one key exam concept here is survivorship bias. Picture a hedge fund that had a rough year, massive losses, maybe the manager left, or the fund simply didn't meet investor expectations. That fund might stop reporting its performance or exit the database entirely. Meanwhile, the star performers keep reporting, looking great on the index. Result? The index paints an overly rosy picture of average hedge fund returns because the duds have vanished. This is a classic pitfall in hedge fund index construction. Underperformers quietly fade away, but outperformers hang around. For you as candidates and for real-world investors, this means that hedge fund indices may not be a perfect snapshot of the true market reality. In other words, always take hedge fund performance numbers with a grain of salt and dig deeper into how that index is compiled. To sum up, the weighting method of an index significantly affects its returns and risk profile. Commodity indices are influenced by futures pricing, collateral returns, and roll yields. REIT indices offer an accessible and liquid way to gain real estate exposure, and hedge fund indices can be misleading if biases aren't considered. And that wraps up our journey through alternative investment indices. These concepts aren't just academic. They're practical tools that investors, portfolio managers, and financial analysts use daily to measure and manage risk and return. So keep these insights in mind as you prep for your CFA Level 1 exam. If you found this helpful, don't forget to like and subscribe to the FinQuiz channel for more practical, exam-focused content. Catch you in the next one.